So, the headline that's been all over the financial news,
Right.
it's finally happened. The Indian rupee has crossed that big psychological mark, 90 to the US dollar. That's a 5.1% drop just this year. So, the big question for our deep dive is this a real crisis? Or is there something more strategic going on here?
It's definitely more than just a simple crisis. I mean, it's not one single thing, that's for sure.
Yeah.
You're seeing this collision of powerful forces. On one hand, you have uh, global headwinds, significant U.S. tariff hikes, and foreign portfolio investors pulling money out.
So, money flowing out of stocks and bonds.
Exactly. And then domestically, you've got a record trade deficit, a huge surge in gold imports, and that persistent current account deficit. So it's the perfect cocktail to push the rupee lower.
Right.
And, if you zoom out a bit, this isn't some sudden shock to the system. This has been a long time coming. I mean, ever since the 1991 liberalization, the rupee has been on this slow, consistent depreciation journey.
A long-term trend, then.
A very long-term trend. It averages out to roughly 4.5% loss per year against the dollar for the last 34 years. It's so gradual you barely notice it day to day.
So if it's structural, that almost implies well, not accidental. It suggests there's a strategy at play here. And our sources point straight to the China playbook, don't they?
They do. It's a fantastic comparison. China deliberately let the yuan weaken by almost half against the rupee since 2009.
And they did that for one reason.
To keep their exports cheap and competitive. And this gradual slide in the rupee looks a lot like India playing a similar, slower-paced game.
A shock absorber.
Precisely. It acts as a necessary shock absorber against external pressures. I mean, think about this fact from our sources. U.S. tariffs on India are at 50%.
50%.
Yeah.
Reportedly the highest in the world.
Exactly. A weaker rupee helped cushion Indian exporters from taking the full force of that hit.
Okay, but a lot of people will see the rupee at 90 and say, where's the RBI? Why aren't they defending the currency tooth and nail?
That's a really common misconception. The RBI isn't fighting the direction of the rupee.
They're managing the pace.
Yes. The system is often described as crawl-like. They let it move, but in small, gradual steps. They step in to prevent the sharp, chaotic drops that would spook the market.
So letting it slide, but just slowly. No sudden panics. And they have tools for that, right? I saw they're using forward contracts pretty heavily.
Very heavily. They're running a, USD 65 billion short forward book?
Yeah.
In simple terms, it's like promising to sell dollars in the future to absorb today's volatility and keep everyone calm.
This all sounds very managed, but it still feels a bit precarious. It brings back some worrying memories of that 2013 Fragile Five crisis. Why is this time different?
It's a completely different economic landscape. Back then, you had runaway inflation and a massive 4.8% current account deficit.
And we were totally dependent on that volatile foreign money, which just vanished.
It did. But today, the fundamentals are so much stronger. Inflation is under control, we have ample Forex reserves, and this is really the key. Our services exports are booming. That provides a powerful, permanent cushion for the economy that just wasn't there a decade ago.
So let's talk about the real-world impact then. Who are the winners in this scenario?
Well, the winners are pretty clear. It's the exporters. If you're in IT services, pharmaceuticals, textiles, gems, and jewelry, all of a sudden your foreign earnings are worth more when you bring them home.
And on the flip side, the losers.
The importers, of course. Oil and gas, aviation, electronics, their costs are going up. And, any individual paying for a foreign education or planning to travel abroad feels that pinch immediately.
But with those higher import costs, especially for oil, the big fear is always inflation. Why isn't this translating into a painful price spike for everyone?
Because India's inflation story is largely a domestic one, mostly driven by food. And since we rely very little on imported food, we're sort of insulated from that specific pressure.
So there's a disconnect.
A very helpful one. Our analysis shows a 5% currency depreciation only adds a marginal, 15 to 25 basis points to overall inflation. It gives the RBI a lot of breathing room.
So the big picture takeaway here is that the fundamentals are holding up.
They really are. Growth is healthy, inflation is managed, and the reserves are strong. India seems to be navigating this not as a crisis, but as a calculated adjustment for competitiveness.
Which leaves us with a final thought for you to chew on. Given the structural need for competitive exports and the long-term trend we've just discussed, is India's crawl-like depreciation policy now a permanent and even necessary feature of its growth strategy? Something to think about.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.